Hey traders, Tyler here with the Speculators Guild, also known as Gilded Golf Trader in the Discord. Today I want to talk to you guys about trading indicators and why they fail. We're here to talk about why most retail traders struggle and why those complex indicators that you rely on so much are actually holding you back. The truth is, 90% of trading indicators fail because they are fundamentally flawed by reading modern markets. We're going to explore how institutional traders read the market differently, focusing on the underlying auction dynamics instead of lagging formulas. This isn't about finding a new indicator, it's about adopting a superior framework for market analysis. By the end of this session, you'll understand why auction market theory is the only way to read the markets like a professional. Let's start by looking at the core problem with traditional indicators. The fundamental problem with traditional indicators is that they're always late to the party. Indicators like RSI and MACD are mathematical formulas applied to past price data, meaning they can only react to the move once it's already happened. By the time that calculation triggers a signal, the institutional money has already made its move, leaving you to chase trades well in the dust. You're analyzing a derivative of price movement, not the actual supply and demand dynamics driving the market. Professional traders don't rely on these lagging formulas. They read the market auction in real time. This lag exactly why so many indicator based strategies consistently fail. Let's look at the classic example of this failure. One of the most common traps taught to these retail traders is the concept of RSI divergence, which often costs traders money. The textbook signal says that when price makes a lower low but RSI makes higher lows, you have a reliable buying signal. But in reality, this divergence often appears long before any actual reversal happens, and price frequently continues dropping, triggering your stop loss. The root cause is that you are analyzing a derivative, the RSI, instead of the actual market structure and the selling pressure. Institutional traders aren't watching the RSI. They're reading the order flow and the auction dynamics. Market structure always overrides these mathematical patterns. So, if indicators are derivatives of the past, what should we be focusing on? The key shift in perspective is realizing that every market is fundamentally an auction, a continuous negotiation between buyers and sellers. Forget your candlesticks for a moment. The market is simply seeking fair value through price discovery. Market profile charts reveal where the market spent time at each price level, which is critical piece of information. The value area shows where 70% of the day trading occurred, representing the agreed upon fair value. The point of control, or the POC, is the single price where the most trading has happened, acting as the market's center of gravity. This focus on time and value is truly what reveals market acceptance. Now, let's see how market profile can give us an edge that candlesticks could never provide. Market profile gives us the ability to read price rejection and acceptance with crystal clarity, something candlesticks simply cannot do. When price moves outside the established value area and it is immediately rejected back inside, the market is screaming to us that the price was unfair. This rejection is a collective judgment of market participants. The value area is not a formula, it's a visual representation of where the majority of trading consensus lies. Candlesticks only show you where price went, but market profile shows you how long it stayed there, revealing conviction. This real time reading of the auction gives us a massive advantage over traders relying on lagging indicators. We just discovered how market profile reveals acceptance and rejections. Now, let's look at a real world example of this and how it translates into a high probability trade. This ES futures trade shows exactly how reading the auction provided a 3-to-1 risk reward setup without any traditional indicators. The key signal was the market's rejection of higher prices after an overnight exploration. Price pushed above yesterday's value area but found no conviction, signaling that higher prices were not accepted by the majority of participants. When price rejected back inside of the value area, We had a high confidence short entry at the value area high. This is the power of reading the auction. You trade based on market structure and consensus, not a lagging mathematical formula. This single example illustrates the core difference between reaching a price and understanding the market's intent. This leads us directly to the complete framework that makes these trades possible. That real world trade example demonstrates the practical application of auction market theory. Auction market theory is not just a tool, it is a comprehensive framework for reading markets like a professional. Unlike isolated indicators, auction market theory is based on the fundamental mechanics of how markets operate, the continuous negotiation between buyers and sellers. The framework integrates multiple core concepts, including market structure, the point of control, and real time order flow analysis. When you combine these elements, you gain a holistic view of the market's intent, allowing you to adapt to any condition. This systematic approach is what we teach to build consistent, confident traders. So, how do we structure the learning process of master this framework? Mastering the auction market theory requires a structured approach, which is why we built this 4-week mentor program. We start with the foundations in week 1, ensuring that you understand the core concepts like value area and point of control. Week 2 moves into the advanced value analysis, teaching you how to identify high probability setups like trading the failed auction. By week 3, we integrate order flow execution, showing you how to read institutional footprints and time your entries with precision. Finally, week 4 is dedicated to building your personalized playbook, ensuring you leave the program with validated setups that fit your unique trading style. This systematic progression is designed to transform you, an indicator dependent trader, to an independent market reader. But remember, the goal of this program is much bigger than learning a few steps. We need to be clear about the ultimate goal. It's not to give you signals to follow. The goal is to give you a new lens to read the market through. When you understand auction dynamics, you gain independence from those lagging indicators that have held you back for so long. You develop the adaptability to read any market in any condition and know exactly what is happening in real time. This confidence comes from reading the same structural information that institutional traders use every day. It's a complete paradigm shift in how you approach trading now. If you're ready to make the shift and gain this professional lens, then I invite you to come join us. If you're tired of relying on indicators that lag and setups that fail, it's time to stop struggling and start reading the auction. This is a mentorship, not a mass market course, and we cap enrollment to ensure every student receives personalized attention and feedback.